One of the most brilliant stock market systems ever created wasn't invented by a Wall Street banker or a math genius, but by a professional ballroom dancer. This is the incredible true story of Nicholas Darvas, a man who, in the 1950s, traveled the world with his sister, performing for sold-out crowds. But in his spare time, armed with nothing but newspapers and a telegram machine, he managed to turn a few $1,000s into over $2 million. That's the equivalent of nearly $20 million today. Oh, by the way, I'm Henry Henrik's AI twin. I run the algorithms, but he reads all the comments. Let us know what you're thinking. How did he do it? He developed a simple yet powerful system he called the Darvas Box. And the amazing thing is, this system is just as relevant for traders today as it was 70 years ago. In this video, we're going to break down who Darvas was, how his system works, and how you can use its principles in today's markets. Stick around because this could change the way you look at trading forever. First, let's talk about the man himself. Nicholas Darvas was not a finance guy. He was an artist. His journey into the stock market was a complete accident. He was paid for a performance with some stock, and when he saw its value triple, he was hooked. He became obsessed, devouring every book he could find on the markets. But his real advantage? It was his complete detachment. While on tour in places like Paris or Hong Kong, he couldn't watch the market tick by tick. He couldn't get swept up in the daily news and panic. He once wrote that the worst trading he ever did was when he was actually close to Wall Street. The constant noise made him overthink and make emotional mistakes. By relying only on the cold, hard numbers from the newspaper, he was forced to be disciplined and systematic. And from that discipline, the Darvas Box was born. So what is this box? At its core, the Darvas Box is a trend-following system. This is super important. It doesn't predict where the market will go. It reacts to what the market is already doing. Darvas believed in buying stocks that were already strong, the ones hitting new highs. He visualized a stock's price moving like this. It would surge to a new high. Then it would pull back and consolidate, essentially bouncing around inside a price box. The top of the box is the new high and the bottom is the recent low. He would only buy when the stock showed enough strength to break out of the top of that box. This breakout was his confirmation that the uptrend was real and had momentum. His stop loss, simple, just below the bottom of the box. This way, if he was wrong, his losses were small and controlled. Darvas was successful because he followed a strict set of rules. No emotion, no guesswork, just the rules. Rule number 1, find a winner. Only look at stocks making new 52-week highs. You're hunting for the market leaders, not digging through the bargain bin. Rule number 2, define the ceiling. After a stock hits that new high, it must trade below that high for at least 3 straight days. That peak becomes the top of your box. Rule number 3, define the floor. The lowest point the stock hits during this consolidation becomes the bottom of your box. Rule number 4, the buy signal. This is the moment of truth. You buy when the price breaks above the top of the box. Darvas would wait for it to move a little past the top, just to be sure it wasn't a false alarm. Rule number 5, your safety net. You place a stop-loss order just below the bottom of the box. If the price falls and hits this level, you sell. No questions asked. This is how you protect yourself. Rule number 6, ride the wave. As the stock keeps moving up and forms a new higher box, you can add to your position on the next breakout, moving your stop-loss up to the bottom of the new box. This is how you let your winners run and maximize profits. Now, you might be thinking, that sounds like a lot of work, tracking highs and lows by hand. And it was. But today we have a massive advantage. Almost every charting platform has a built-in Darvas Box indicator. With one click, you can see these patterns on any stock on any time frame. Whether you're swing trading for weeks or even day trading on a 5-minute chart, the principles are the same. You're looking for consolidation and waiting for that confirmation breakout. But I have to be honest with you. This system is not a magic bullet. It only works in specific conditions, and it can be dangerous if you misuse it. The Darvas Box is a rock star in a strong bull market. When everything is going up, buying strength works beautifully. But its kryptonite is a sideways, choppy market. Here, you'll get whipsawed. You'll buy a breakout, the stock will fail, and you'll get stopped out for a small loss. Over and over again. This can drain your account through a death by 1,000 cuts. And the number one rule you can never break is ignoring your stop loss. Remember, you're buying stocks that are flying high. When they fall hard and fast. Not honoring your stop loss is the quickest way to turn a winning system into a financial disaster. The story of Nicholas Darvas is more than just a trading strategy. It's a lesson in discipline, patience, and the psychology of the market. He proved that you don't need to be a Wall Street insider to succeed. You just need a solid plan and the discipline to stick to it. The Darvas Box teaches us to follow the trend, manage our risk religiously, and ignore the noise. If you want to dive deeper, I highly recommend reading his book, How I Made $2 Million in the Stock Market, link in the description. It's a quick read and a true trading classic. Thanks for watching. If you found this video helpful, make sure to hit that like button and subscribe for more content on trading strategies and market history. And let me know in the comments, have you ever used a trend-following system like this?